Okay, welcome everybody. Thanks for joining. We have an exciting video today. We're going to be talking yet again about Cathie Wood and ARK Invest. And I know that I've made some recent videos about them on my main channel. One of them was how I criticized Cathie Wood and ARK Invest analysis on Tesla, saying that they're going to be a $2-3 trillion company in 5 years, that they're going to have a robotaxi service that revenues $300 billion in 5 years. I just think that these predictions were very overly optimistic. I think that some of them are detached from reality. So that's a video that I've already made, but this one's going to be a little bit different. The analysis firm Morningstar, which is one of the most well-respected analyst firms in the world. They control hundreds of billions of dollars worth of money under management, as well as they employ thousands of analysts that research these different companies, and they specifically focus on funds, ETFs, mutual funds, different types of funds. Well, they came out with an analysis on ARK Invest, their first full analysis on it, and I would only describe it as scathing. It was a scathing analysis. It was brutal. What they go through and the things that they highlight about Cathie Wood and ARK Invest, I think was a brutal critique of this fund. So even if you're invested in ARK Invest, which I know a lot of people in the community here, in the comments section, a lot of the viewers are invested in these different funds. Even on my own Discord and Patreon, there's a lot of members that have a lot of money in ARK Invest. I think this is good to listen to know the different opposing arguments for your investments. And I do the same thing. I show my investments publicly every single week on both my accounts. I have the story fund, which is my hyper growth, aggressive portfolio. I have my dividend portfolio, and I show what I'm invested in. And I get a lot of pushback and critique on these different companies. People say that Netflix isn't going to do well in the future, that they're going to get caught up in competition. They're going to perform really poorly in the future. There's some people that think I'm crazy for investing in things like Spotify, that the music labels control everything. And why would I put any money in these companies? I get harsh criticisms for a lot of things that I invest in. DoorDash people act like I'm crazy to even put any money in this company. So even though I get pushback, I still think it's good because it allows me to review critics and different people's opinions about my investments. And it usually ends up making my total portfolio and my investments, I usually have more conviction about them at the end. I usually am more convinced of my investments, or either I do take and accept other people's arguments and I move out of those investments. So either way, getting critique and criticism and scrutiny over what you're invested in, I think is a good thing. So even if you're invested in these ARK Invest funds and you're a follower of Cathie Wood and you like the funds that she creates and the investments that she has, I think this video will be very interesting to watch Morningstar's or to listen to Morningstar's really brutal critique of their funds. So we're going to go over all of it in this video. I'll be going over all of Morningstar's write-up on this. I think that some of it is again, it's a pretty scathing review, but we'll read through it together and you'll get my reaction. Now, of course, before we jump into the main story of Morningstar's brutal review of ARK Invest, I have to give an update on my portfolio, the Story Fund. If you're new to this channel, the Story Fund is a highly aggressive, growth-centered portfolio. It's mine, and I show it every single week on this channel. So if you want to follow along and see the progress of this and the returns, well, just subscribe to the channel and you'll be able to see an update every single week. But basically, the companies that I pick out in this portfolio are ones that, first of all, I think I know about them. I know the products and services. I'm familiar with them, as well as they're companies that I think offer really good risk-adjusted returns. And they have a lot of characteristics that I think define the companies that will have better compounding in the future than other companies. They have factors that are internal flywheels. They're compounding effects of the companies. Like they typically have first movers advantage. They're in future industries where the whole industry itself is growing. They offer products that are convenient, simple, easy. They're usually founder-led, so on and so forth. There's a lot of characteristics. In fact, if you want to read more about the type of things I look for with these companies, there's a link in the description called the Story Fund Write-Up. It's a Dropbox link. You can click on that and open it up and just read it for free. It outlines the type of things I look for in these type of companies. Now, I do benchmark my performance of the Story Fund against the market. And by the market, I mean the S&P 500. So the S&P 500 is the 500 biggest companies in the United States. They're weighted by market capitalization, and it represents the market. And then I benchmark the Story Fund, which is in blue, against the S&P 500, which is in red. And this is accurately benchmarked as if I had made deposits into both of them at the same time. So this draws an alternate reality as if I had invested my money into the S&P 500 in the same amounts at the same days. And then you can see the outcome here. Now, again, the story fund is in the blue, and you can see that over a good period of time, I was returning quite a bit higher. Then we had the sell-off earlier this year in high multiple growth companies, and then we had a lot of value stocks outperform, and that made it so that the story fund actually dipped below the S&P 500. So I was underperforming for a time. Then it dipped back up a little bit, and then back below. And as of right now, as of the past hour when I updated this, I'm beating the S&P 500 by just like 2%. The story fund has returned 16%. The S&P 500 has returned 14.8%. So I'm beating it just by a little bit. But that's the update so far. The story fund, again, it's just getting started. This is going to be something that over the next 5 years I track, and I try to outperform the S&P 500. Outperforming this red line is the goal of this portfolio. I want to beat the S&P 500. So if you want to follow along with this journey and this little competition I have between me and the S&P 500, just subscribe to the channel. You can follow along for free. If you want to go a little step further and get every single notification of every buy and sell I do and different companies I'm looking at, you can check out the Patreon. There's a link in the description. It gives you access to a Discord community where I post every single buy and sell I do, and I do that very transparently. There's a whole channel in that Discord where I post instantly every single buy and sell I do. So if you're interested in that, you can check that out as well. Okay, now let's go ahead and jump into the main subject here, Morningstar's review of the ARK Invest funds. Now, before we jump into the actual write-up itself, I want to go over what Morningstar actually is, because not everybody might be fully familiar with them. Morningstar is one of the most influential analyst firms that exist. It's one of the biggest and most influential. They control a lot of money, they hire a lot of analysts, and they actually have a material impact on which funds get a lot of assets under management based on their ratings. So if a fund has really good ratings from Morningstar, then a lot of firms, a lot of people that have big money will move their money into those funds that Morningstar likes. That's how influential their firm is. So it says here that Morningstar is an American financial service firm headquartered in Chicago, Illinois. They provide an array of investment research, yada, yada, yada. They were founded a while back. With operations in 29 countries, Morningstar's research and recommendations are considered by financial journalists as influential in the asset management industry. So they are influential. And a positive or negative recommendation from Morningstar, analysts can drive money into or away from a given fund. And the Wall Street Journal has confirmed this. Funds that get 5-star ratings and they get praises from Morningstar will receive inflows of billions of dollars of assets under management. So they are very influential. It says through its asset management division, the firm currently manages over $215 billion as of September 30th, 2020. And there's actually a lot of funds themselves that are based off of Morningstar's analysis. In fact, one person that used to work at Morningstar, one of the people that did their whole write-ups about moats and tried to quantify moats into an actual equation, he runs a fund called Moat, M-O-A-T. And that one has actually outperformed the market. So Morningstar is a pretty big deal. They're a big analyst firm. They're usually integrated into a lot of brokerages. I think they're in Robinhood, they're in Schwab. A lot of them try to offer Morningstar and some of their services for free because it gives legitimacy to the brokerage. So that's what we're looking at with Morningstar. And they recently came out with a write-up on ARK Invest, which we're going to look at now. This is from the ARK Innovation ETF, ARK. This is where they have the write-up. Now, the first thing I'll mention is it has 5 stars because that's based on an algorithm that compares the previous performance of this fund against its peers, against other funds. And obviously, ARK Invest so far has performed amazingly. It's one of the best performing funds over the previous 5 years. So it earned itself a 5-star rating. Now, the actual consensus from the analysts at Morningstar is a neutral, which is not a good rating. You want at least good, or you want one of the premium ratings, one of the best ones, right? Neutral's no good. That means that the fund has very mediocre ratings from the analysts. So on the algorithm basis off previous returns, it has 5 stars. From the actual analysts, what we'll be looking at today, it has a neutral, which is not good. Let's go ahead and jump into the actual write-up. And again, if you're invested in these funds, it's okay. Just listen to this because it's going to be a little bit brutal. This review is a little bit brutal. The thematic approach is ill-prepared for a major twist. That's the headline of it. This is Robbie Greengold, the analyst that did this. We'll start off. ARK Innovation ETF, ARK-K, has been in tune with the market's unfolding narrative in recent years, but its lone portfolio manager, inexperienced team, and lacks risk controls make it ill-prepared to grapple with a major plot twist. It earns a Morningstar analyst rating of neutral. That's their first paragraph. And this is not the worst of it. I promise you, this gets much, much worse as we go on with it. But right there in the very first sentence, they're saying its lone portfolio manager, inexperienced team, and lacks risk controls make it ill-prepared to grapple with a major plot twist. That's the first line of this. And again, keep following along, it gets much worse. The fund's main draw is portfolio manager Cathie Wood, who after more than 3 decades in the industry founded ARK Investment Management in 2014 and has overseen its rapid asset growth during the past year. So if you actually look at a line of the assets under management from ARK Invest, it was pretty low, growing a little bit, and then it went up like crazy as they had a lot of new investors pile on over the past year. That's what brought it into Morningstar's radar, is now a lot of people are invested in it. We better actually look at it and give some analysis on it, right? Now, the next category here is called process. This is a rating that, and a section that Morningstar reviews of every single ETF and mutual fund that they cover. And it's basically, how does this fund, what is the process of them picking stocks? What is the process of them weighting them? How do they control for risk, right? What is their whole process for constructing their portfolio? And they give it a review and a rating. And the first thing they say is, a go-with-your-gut approach to the portfolio's risk management earns the strategy a below-average process rating. And again, below-average process rating is not good. That's not a good rating. So Morningstar to ARK Invest gives them a below-average, and they describe their method of risk adjustment, their method of controlling for risk in their portfolio as a go-with-your-gut approach. That's how they're describing ARK Invest. They go on to say, ARK's firm-wide investment philosophy has some merit. It is benchmark agnostic and invests across 5 technology platforms: artificial intelligence, blockchain, DNA sequencing, energy storage, and robotics, which its investment team thinks will revolutionize how economic sectors across the globe operate. I think that accurately defines ARK Invest. They invest in a lot of futuristic technologies that they think will redefine and disrupt the future, right? They say it shoots for high returns by investing only in companies it thinks will gain 15% or more annualized over the next 5 years, trading in and out of stocks, and during market crises, concentrating the portfolio around 30 pure plays, which are often unprofitable small caps that are less liquid and extremely volatile. So that's basically what ARK Invest is doing. They shoot for high returns. They're investing in only stocks that they think will gain 15% or more annualized for the next 5 years. I'm doing the same as that, by the way. In the Story Fund, I target companies that I think will beat a 15% annualized return. But they say that they trade in and out of stocks. I don't do that. I just buy companies I think will internally compound at a rate more than 15%, and I hold them. They're saying that ARK Invest trades in and out of stocks, and they absolutely do. If you subscribe to the ARK Invest daily, their daily stock moves, they trade like 50 different positions every single day. It's pretty insane the amount of actual trading that ARK Invest does. They're not buy and hold investors. They are what I would consider almost day traders. They trade in and out of positions every single day by the billions. It's pretty crazy. They say, and during a market crisis, they concentrate their portfolio to their 30 pure plays, which are often unprofitable small caps that are less liquid and extremely volatile. But the firm lacks a robust approach to mitigating risk. So they're saying they don't have really any type of approach to mitigating risk. Cathie Wood relies on her instinct rather than data or rules. The firm, which has no risk management personnel and vaguely defined risk controls, views the subject almost exclusively through the lens of its bottom-up stock research. But this provides little visibility into the portfolio's aggregate risk exposures, which can make or break a fund's returns during one market environment or another. The firm is poorly positioned. Okay, they're poorly positioned to prepare and react. That's something that they highlight here. After growing its assets to roughly $80 billion as of February 2021, from less than $12 billion a year earlier, the firm faces new risks that it seems to manage haphazardly. Okay, so they're saying that the growth of their firm and the assets under management have introduced new risks that ARK Invest really isn't equipped to manage. While it most resembles the Russell Mid-Cap Growth Index, the portfolio looks unlike any index or pair in the mid-growth Morningstar category. So ARK Invest doesn't really resemble anything else. It is willing to be among the most concentrated funds in the category. So they have a lot of concentrated risk in ARK Invest, right? They have a lot of money in Tesla or in Square. They're a very concentrated fund. While its 57 stock portfolio as of February 2021 wasn't too far from the pair norm of 65 to 85, Cathie Wood is apt to sell its most liquid and large cap stocks during bear markets to focus on around 30 of her favorites. Its top 10 holdings typically soak up 45 to 60% of assets, more than double the category's norm. So ARK Invest funds have a much higher concentrated risk than any pairs on Morningstar, anything else that they review. It also makes huge industry bets. Biotechnology's 19% share of the portfolio, for example, is nearly 5 times the index's weight. So they have more exposure to different industries that other funds do not have. While its pairs mostly stick to US mid-cap, this portfolio can dart from the smallest to the biggest companies around the globe. In February, its 21% foreign stake was among the category's largest. The fund has become less liquid and more vulnerable to severe losses as its size has swelled to more than $23 billion as of February. It has retained and grown its stake in small companies that are now much more difficult to sell without material impact on the stock prices. So ARK Invest, they own so much of some companies that if they sold, them selling in and of itself would bring down the stock price of that company dramatically. That's how much they own of it. It's a crazy amount of ownership. It highlights it right here. Across all US funds, every single one of them, all US funds, the fund stands out as having the most concentration in companies in which it owned 10% or more of floating shares. It's a record broken by ARK. They own 10% or more of more companies than any other fund. It also can't trade positions as nimbly as before, which hinders its ability to exploit good ideas and oust bad ones. So they're not as nimble as before because they're now becoming bigger. And I think Morningstar thinks that means they'll become a little bit more bloated, more difficult for them to do this day trading that they've been doing. So you can see Morningstar is not a fan of how ARK Invest has constructed their portfolio and their process for doing so, their process for controlling risk with their portfolio. They describe it as a go with your gut risk management, go with your gut. They describe it as having a lot of risk with concentrated risk of a single portfolio manager. Cathie Wood is it. She's the only one that has the experience to run this portfolio. So you have the concentration of everything being managed by one person, by Cathie Wood. Then you have the risk of concentration risk with the top 10 holdings. A lot of ARK Invest's, their portfolio is concentrated into these top 10 holdings. You have the risk of a lot of concentration and exposure to industries that really aren't that proven, like biopharmaceuticals and these type of things that really aren't that profitable as of right now. And then you have the risk of ARK Invest owning over 10% of a lot of different companies, which means that it's very illiquid. If ARK Invest decided to sell out of one of these companies, they couldn't do it in just a few minutes like you could selling a few shares of PayPal. You can't sell 10% of a company in a few minutes. So trying to exit those positions would be very difficult, and it makes it higher risk for the investor. And then they also have the risk of being very big and bloated with the amount of assets under management, making it so that they can't do this day trading that they've been doing, buying and selling different companies super fast every single day. They can't do that as good when they're managing $20+ billion as when they're managing $5 billion. It's simply more difficult to do. They can't be as nimble, which might hamper their future returns. So they're saying overall, there's all these different risks. They don't think that ARK Invest is doing a good job. That's why they gave them a below average on the process rating, a below average. Now, the rating that they give them on people is also not great, but it's not quite as bad. They give them average. They say that ARK Invest has an average people rating. The people rating, of course, is a rating given for the people actually working at ARK Invest. Who do they have as their analysts and their portfolio managers, right? Who do they have as their research team? Well, they give it an average rating. They say the fund's investment team is mostly inexperienced and hasn't settled after years of churn. So they're still hiring and firing people. They're still dealing with churn. It earns an average people rating. So not below average, not terrible, but average is still not great. They say since founding ARK in 2014, Cathie Wood has been the firm's loan portfolio manager across all of its ETF strategies. She honed her process at AllianceBernstein from 2001 to 2013, where the thematic strategy she ran had high volatility, poor downside performance, and underwhelming long-term results. During her 12 years at the helm of the large growth strategic research, its before fee returns outpaced the Russell 1000 Growth Index but lagged on a risk-adjusted basis. She also ran 2 other growth-oriented funds whose net of fee results underperformed their bogeys on her watch, risk-adjusted or otherwise. So one of the funds slightly outperformed the 1000 Growth Index, but not on a risk-adjusted basis. And then 2 other funds she ran both underperformed their peers on a risk-adjusted or otherwise. Just totally, they underperformed. So that's her history. Wood's current 10-person research team bears little resemblance to its early 2018 iteration. So in 2018, the team working at ARK does not resemble what's currently there right now. Many analysts have been hired, but few have stuck around. Just 3 members, including Director of Research Brett Winton, have tenure at the firm of 3 years or longer. They have, at ARK right now, 3 people that have been there for longer than 3 years. That's how much churn they have. So if you're thinking that it's the same team that was working with ARK Invest for the past 5 years and they're doing the same thing right now, you're mistaken. Only 3 members there currently have a tenure of longer than 3 years. Most of the analysts hired since 2014 came without significant experience as stock analysts, technical experts, or forecasters. The few with full-time work experience before starting at ARK, the few with full-time work experience before starting at ARK, I think that's crazy. I think they should be hiring people that have full-time work experience. They came from relevant fields such as epidemiology, but the team does not stand out next to rivals that employ and retain in-house specialists with advanced degrees. So they're basically saying, Morningstar is saying that ARK Invest is hiring a lot of novice people, a lot of green people, and the few that do have experience don't have as much experience or as much knowledge and advanced degrees as other firms. I'm sure they're talking about like Goldman Sachs, JP Morgan. Those guys can hire people that are, especially, they have advanced degrees. They can pay them a lot of money. They can find people that are extremely skilled in epidemiology and robotics and technology. They can hire all the people from all the elite colleges and stuff. And ARK Invest doesn't. Their talent doesn't stand out next to the people that they have working at other places. So again, it's not the worst rating, but they give it an average, not great. There's other funds that have above average ratings. Now, next up, we have the parent rating. And this is the last segment that Morningstar goes over. This is kind of like, how good of a steward has ARK Invest been over your money, right? Have they been responsible with it? Have they been growing their brand and their fund in a good way? And I think this is actually the most positive segment that Morningstar gives on ARK Invest. They still give it an average, but I think it's mostly positive. They say ARK Invest management has done some things right, but has room to improve. It earns an average parent rating. ARK's main draw is its founder, CEO, and sole portfolio manager, Cathie Wood, who since launching the firm in 2014, and notably over the past year, has presided over tremendous returns and inflows across the exchange-traded fund lineup while establishing a broad media presence and enthusiastic following. So she has a lot of fans, made a lot of good returns, and has a lot of assets under management. Everything has been going good for Cathie Wood over the past couple of years. The firm has thoughtfully developed its products by focusing on one it thinks has longevity, and its ETFs are cost competitive relative to actively managed funds or actively managed rivals. So ARK Invest is competitively priced. Their fees are not really that bad for an actively managed fund. They say, nevertheless, right? This is the big but. They say, nonetheless, potential risks are an issue. As the primary investment decision maker, Wood is essential to the firm's continued success. Director of Research Brett Winton, they go over how this guy really doesn't have any experience being a portfolio manager. He would be the one likely to ascend to the helm in her hypothetical absence, but his nearly 15 years of industry experience include none as a portfolio manager. So if you're investing in ARK Invest, you're really relying just on Cathie Wood. That's who you're relying on. And most people are okay with that. I don't think that's such a bad thing to have one person have basically sole control over the portfolio management. But Morningstar is highlighting that as a risk. You have one person that really is controlling the whole portfolio of all these funds. The firm's analyst ranks have endured considerable turnover, suggesting the lack of viable career track. So Morningstar is saying, what's going on at ARK Invest? Why don't employees want to stay there? Do they not see a good career? Are you not paying them enough? Are they not moving up in the ranks? You need to do something to keep talent at your firm. You need to make it so people want to stay there for the next decade. So they're kind of suggesting to ARK Invest to invest more in their own talent and retaining talent rather than letting JP Morgan and Goldman Sachs and all these other banks that do investment banking steal your best employees. So ARK Invest has not been good at keeping their employees. ARK should also invest in its substandard risk management infrastructure. Considering that Wood's lofty return expectations saddle the concentrated portfolios with highly risky investments. So that's a big thing that investors ignore, is they want returns, but they don't look at the risk and the exposure and the potential of downside being offered there to get those returns. If there's a tremendous amount of risk to get returns, usually you want to avoid that. You want to go into investments that have a low chance of potential downside, a really good chance of upside. So you want a very good asymmetric investment there. And they're saying that this is kind of the opposite, that there's a good chance of upside, but the expectations, these high expectations that ARK Invest is making, Tesla going to $3 trillion, these are very risky investments. That's what Morningstar is highlighting. That is basically it. They go over the performance and price and a few other things, but this is their actual analysis. So there you go. There is Morningstar's, I think, brutal analysis of ARK Invest and their funds and Cathie Wood. Now, I know if you're a person that's invested in these funds, if you're invested in ARK Invest, it's probably difficult to listen to. It's highly critical of your investments. And I know how that feels to have people be highly critical of your investments. Sometimes it's hard to listen to because you're going, well, they're not portraying this accurately, or they're not explaining this. And you're probably thinking that with Morningstar. And what I would say is, don't just look at Morningstar and listen to what they say and base your decision solely off of that. They bring up some good points. They bring up some valid criticisms and some things that you can look at and learn from if you're invested in these funds. Maybe you should look at the turnover of their employees, their analysis. Maybe you should look over their concentrated risks so you better understand what you're invested in. There's a lot of things that I think Morningstar accurately highlights in this review, but I would not look at what Morningstar says and base your investment decisions solely off of that. I don't do that myself. A lot of the companies that I'm invested in that I have big bets on are ones that Morningstar does not agree with. For instance, we can look at this one. We have Netflix. Netflix, they say, is fairly valued at $250 a share. I have been buying Netflix at close to $500 a share for the past 6 months. I think that Netflix currently is undervalued. Morningstar thinks that Netflix is currently way overvalued. So you can see that we have a disconnect there. I've read their analysis. I've heard their arguments. I don't agree with them. I think that Netflix will be worth far more in the future than they are today. I think it will give good risk-adjusted returns. I could be right, or Morningstar could be right, but there's a disagreement there. I still look at their arguments. I still look if they're valid and if I agree with them. But the point being, I don't instantly make my decisions based off of other people's analysis. I consider them, but I don't make my decisions based off of them. Another one we can look at is Spotify. I think that Spotify is undervalued. It's one of the most high quality digital assets, a platform that I think is stellar. It's been selling under $50 billion for a long time now. It recently just had a bump up. The last close price was $273. Morningstar thinks it's worth $174. So their analysis on Spotify is that right now it's heavily overvalued. I disagree with Morningstar. I've read their analysis. I've read their arguments. I think that they make some valid points, but I think that they're not considering a lot of things that will change in the industry. Now, one I do agree with Morningstar on, a company I do agree with their analysis on, is Google. This is one that I've read, and I actually agree with most of the points they bring up. They say that Google is fairly valued right now at $2,600, and that the last close was $2,200. So I've been buying a lot of Google. I've said that I think it's one of the best companies in the market right now with risk-adjusted returns, and I still believe that. I think that the fair value right now is closer to $3,000, but Morningstar puts it at $2,600. So I'm a little bit more bullish on Google than they are right now. So the point is, sometimes I agree with them, sometimes I do not, but I always consider other people's analysis. So if you're invested in ARK Invest, I think it's something to consider. I hope this video was informative, thought-provoking, maybe it helps you consider some different things about ARK Invest. Given the popularity of them, I think there's a lot of people listening to this that are invested. So I want to know your guys' thoughts. Leave a comment, see what you think of it. And if you want to join the Patreon, you can check it out. There's a link in the description. You can join that, and then you can discuss this type of stuff on the Discord on a daily basis. And of course, if you haven't already, pick up the 2 free shares from Webull. They're giving away money. Just sign up, deposit $100, and you got some free money. You can close your account right away afterwards. It's literally free money, so you can try that out as well. Anyways, I'll talk to you guys next time.